Ray Dalio has just sold over $870 million worth of his stock holdings. The legendary investor has made big changes to Bridgewater Associates' portfolio positioning in Q1 of 2024. This follows recent comments from Ray Dalio on the global debt situation. He stated he was concerned about treasury bonds because of the high debt levels, which high interest rates are adding to. In this video, we will look at how he is adapting his hedge fund's portfolio to his shifting global economic outlook. Let's start by looking at what positions Ray Dalio has been selling and why. According to his 13F filing for the first quarter of 2024, Ray Dalio cut his holdings in many major companies, including Procter Gamble, Walmart, Costco, Coca-Cola, Pepsi, McDonald's, and Visa. These were some of Ray Dalio's largest positions. The adjustments amounted to about $377 million in sales in Q1 2024. So what is he buying instead? Technology stocks. He increased his holdings in major tech companies like Alphabet, Nvidia, Meta, and Microsoft. He bought nearly $1 billion worth of shares in these companies. Today, over $2 billion of the Bridgewater Associates portfolio is in just these 4 tech giants. Mr. Dalio's portfolio is clearly moving away from consumer staple stocks that depend heavily on the consumer and their spending patterns, towards technology stocks that are benefiting from excitement about new themes like AI. Dalio also built a huge $315.89 million position in Apple. He built this from almost nothing in just the first quarter of 2024. A few weeks later, Apple announced Apple Intelligence. It is a new feature that adds artificial intelligence to Apple products, which is expected to drive sales and stimulate demand. Apple will launch the new iPhone 16 with Apple Intelligence this fall, boosting investor excitement. This marks Apple's official entry into the AI race. Apple's stock, that had been experiencing some choppy price action throughout 2022 and 2023, immediately soared following the announcement of their new AI features. So why is Ray Dalio making this big pivot from consumer stocks towards tech stocks? One major concern he has recently stated is the risk of a U.S. debt crisis. He specifically mentioned that he is concerned about the softening demand to meet supply for U.S. Treasury bonds. He believes that the U.S. debt levels are too high relative to the size of the economy and that this is going to translate into higher interest rates in the United States. Indeed, the United States debt load has grown to be about a fifth larger than the size of its economy, and many academic studies show a link between high debt and higher interest rates. A 2003 study published by William Gale and Peter Orzog confirms this. In fact, interest rates in the United States have already risen substantially over the last couple of years, reaching the highest level in over 15 years. And Ray Dalio recently mentioned that international buyers of U.S. Treasury bonds could dry up, and that this could push interest rates in the United States even higher. This isn't just a U.S. problem. Interest rates in most developed economies have been rising violently over the last couple of years. If Ray Dalio's concerns materialize, it could lead to a continuation of this interest rate climb in many developed economies. And this could put pressure on businesses and consumers. Higher interest rates means higher mortgage payments, so less affordable housing, more expensive car loans, and higher interest on credit card debt. All of these things squeeze the consumer and means they are likely to try and cut spending in other areas of their life. So for stocks like McDonald's, Walmart, and Costco, whose revenues rely almost entirely on consumer spending, rising interest rates could bring about a tougher economic environment for these business models. Higher interest rates also simply means that these companies have more expensive financing. These companies often take on debt in order to fund new projects. If interest rates are higher, it makes it less attractive for these companies to fund new projects. That can lead to companies delaying or completely cutting off new investments as a result of higher interest rates. So not only do higher interest rates directly impact consumer spending by increasing the costs of everyday goods, but they also lead to a slower economy, which can also stifle consumer spending. This is why Dalio has moved away from consumer stocks and towards U.S. tech stocks like Google or Microsoft. He wants to reduce risks from high debt and high borrowing costs. So he's focusing on parts of the economy that are being driven by completely different themes, like the rise of artificial intelligence. There's a few reasons why this is smart and a few reasons why it's not. Let's start with the positives. First, tech companies, especially in AI, operate globally. They tap into markets and revenue streams beyond just U.S. consumers. Second, these companies will also serve various industries, including manufacturing, retail, and financial services. This broadens their customer base and protects against local downturns. A recent report by Accenture breaks down a projection of $14 trillion of gross value added, GVA, by 2035, with estimates for AI's impact on specific industries. Third, these companies have higher profit margins than most other sectors of the economy. High profitability is something that financial markets often reward. And finally, tech firms have massive cash piles. This could make them less sensitive to changes in interest rates. For example, Nvidia currently holds about $31 billion, Apple $67 billion, and Alphabet a whopping $150 billion of cash. This means these tech companies can effectively finance any project they want without needing to borrow money at high interest rates. But now the negatives. First, US tech companies are among the most expensive in the world. On a PE ratio basis, these companies have an average PE ratio of 30, which is about 50% more expensive than any other US stock, and around 2 times more expensive than your average Chinese stock. As we've discussed in previous episodes, this is a risk to holding technology stocks today. If the premium that investors are paying today to own US tech stocks deflates, it could lead to a pretty substantial underperformance of these stocks. Second, Ray Dalio could be wrong. If interest rates around the world begin to fall instead of continuing to rise, it could lead to less pressure on the consumer and the global economy. This would benefit the very stocks that he sold, and it could make investors rotate out of overvalued technology stocks into more classic consumer-based companies. Whether you believe that Ray Dalio will be proven correct or not, you can trade all of the stocks that we mentioned in this video at Capital.com.